Accounts receivable. If you really think conceptually about what accounts receivable is, you'll recognize that accounts receivable is just the portion of revenue that you've generated that you haven't collected yet. Okay, and so it stands to reason that the more revenue you generated, the more revenue you expect to generate, the more revenue, the more receivables you expect to get. Again, that's all true barring some major change, or at least some change in how quickly you collect from customers, right? So if all of a sudden you decide you're going to collect from customers far more aggressively, you wouldn't just grow this with revenue. And in fact, what we're going to do towards the end of the course is create a separate schedule for receivables where you can actually have that thesis. For now, we are going to do what happens just about 95% of the time, which is if you make a forecast for revenue growth, you're just going to grow receivables with that revenue growth under the assumption that, hey, they're just going to keep, they're not going to change anything majorly in terms of how aggressively they collect. And when you do that, you're in business. You're just growing your receivables in line with your revenue growth rate. With inventory, you also have to pair up with a core operational driver. There's a very natural driver there. If you think about what inventory represents, it's you have to stock up on iPhones in order to sell them. And where does that get reflected in the income statement? It gets reflected under cost of sales. So the removal of inventories into the customer's hands hits the income statement through cost of sales. And so barring, again, a thesis in changing inventory efficiency, and the term that's used in finance around that is, can we turn over inventory faster? Is our inventory turnover faster, or is there or is our inventory turnover declining because we're becoming less efficient? We have to store more inventory for the same amount of stuff that's shipping out. Barring some thesis like that, which of course there's certainly a way to model that, and we will do that towards the end of the course, but 95% of the time you're simply going to grow this with the cost of sales. How, are your costs of goods sold growing? Now here, interestingly, in the first year, because revenue is declining, cost of sales is declining as well. Mechanically, that you might find this a little confusing. How do I get this growth rate, right? With revenue, we had a growth rate. And by the way, I kind of did this without talking about it. It's very easy. It's very helpful at this point to split the screen. So Alt-WS is a screen split, which helps you kind of like toggle back and forth between two sections of a long model. And so I'll show you how to do that again. I have to go all the way to the left if I want a horizontal split, because if I just do this and hit Alt-WS, it sort of puts a cross in the middle, and it's not exactly what I want. It sort of splits always to the left and to the top of where my cursor is. So I'm going to hit Alt-WS again to undo the split. I'm going to go all the way to the left, right in the middle of the model. I'm going to sort of cue this really nice in the middle here. Alt-WS, this puts a split here, and now it enables me to kind of go back and forth and really see what's happening. So remember, whereas before accounts receivable, I grow with revenue. That's easy. Well, I don't have a cost of goods sold growth rate, but that's okay. If you really think about what's happening, I can go up here, and by the way, you hit F6 to jump from pane to pane. So if I hit equal sign and I use the arrows, I'm still stuck in here. But if I hit F6, notice it puts the cursor on the top left here, and now with the arrow keys, I'm moving around. That's a way to avoid using the mouse here. If you think about cost of sales, back to my point here, again, F6 jumps me back in here, and I hit -1. If I divide the current year minus the last year minus 1, this is an arithmetic thing. It gets me to the growth rate of cost of sales. All right, let me change the formula here. And you see that I'm saying that cost of sales is declining by 3.2%. So now I can leverage the same mechanics that I did before. Take last year's times 1 plus this. Now, those of you who are sort of math inclined can recognize that 1 plus this minus the ones can just cancel themselves out. Can just cancel themselves out. And all I needed to do to actually get at the growth rate for cost of sales is just last year's inventory times the year over year calculation for cost of sales, and I get my inventory. Okay. If you go down to other current assets and recall they are comprised of a whole bunch of stuff, including vendor non-trade receivables, we're going to treat that as a catch-all bucket. And for catch-all buckets that are tied, the most important thing is it's a catch-all bucket, but these are current assets. They're kind of like receivables, except they're non-trade receivables. The assumption here, and almost always is the case, when you've got working capital line items that are tied to your operations and you don't know exactly the core drivers, you kind of regress to the lowest common denominator of the operating driver, and that is revenue. So I'm going to assume that this grows as revenue grows. I think that's a very reasonable assumption. Again, the key there is for you to feel like you're modeling something that would actually grow as the business grows itself. It is tied to the core operations of the business. That is almost certainly always true with working capital assets and liabilities. Okay. Property, plant, equipment, we're not going to be able to forecast quite yet. That's going to come from a PP&E schedule, and that's when we're going to have to forecast D&A. We'll be able to calculate EBITDA finally. Last but not least, other non-current assets. So these non-current assets, if you recall, there is, in fact, actually, before we get into this footnote, I want you to look at what the actual disclosure, just to refresh yourself. If we go back to the balance sheet for Apple, what are they actually doing here? So here's Apple's balance sheet, and they've got this catch-all, this $22.2 billion, and here it is right there. They don't really tell you much about what's in there. And this is maybe a little above and beyond when you build the model for the first time, but because we've been modeling Apple for a while, we noticed that Apple actually kind of changed what they did here. They used to actually include goodwill. So we do, even though Apple doesn't disclose it in 2018, in prior years they have disclosed it, that they used to separately identify goodwill and tangible assets. Notice that's missing from Apple's 10K. Those of you who've taken at least a semester of accounting, and I should say, if you are struggling with the accounting here, I would go back, I would take our short accounting crash course to kind of give you a sense of this. But there are a couple of line items on the asset side that you would expect to see for most companies, goodwill, intangible assets. Apple started lumping them all into other non-current assets. You wouldn't know that here because they don't actually report that in a note or anything, but we do know that just by going back to prior 10Ks. And so without knowing that, it's, again, this catch-all. And there are really two choices here. One is you could say, well, they might not do any more acquisitions and intangibles may not go up, and we don't really know the nature of they're non-current assets, so technically they could be financial assets. They may not be fundamentally tied to operations like inventories, receivables. But our feeling on this is that even though you don't know and you have to make a call, it is more likely, certainly with intangible assets, companies are going to keep acquiring, maybe not exactly at the same rate as revenue growth, but over a long enough time frame, and we're forecasting this over 5 years, it is actually safer. It's more conservative to assume that the company will grow its intangible items, its goodwill, and really anything that's non-current as well with revenue. There's no right answer for this. A lot of times if you build a model and you just straight line this, for example, that would be acceptable as well because you say, I just don't know what this is. But our preferred approach for these line items is to also grow them with revenue. We think it's more likely to actually be accurate. And so that's what we're going to do here. And then we're going to paste this, the subtotal. Notice it's catching a cash line item that we haven't built out yet. And so because cash is such a huge part of what's going on with Apple, this is going to be very underinflated until we get to the cash flow statement.